Understanding the relationship between oil and a country's currency can influence how you place forex trades.
I like to watch how much oil the U.S. dollar can possibly buy. If the U.S. dollar index is falling, if the purchasing power of a dollar is falling, oil prices will go up, and I'll look to buy oil.
If you believe a move in oil prices is a long-term trend, then this will be beneficial to Norway, Canada, Mexico, and you would buy the currencies.
Asian currencies have a negative relationship with oil because Asia is a big importer of oil. So when oil prices rise, they have to pay more for oil, which has a negative impact on their economies, and their currencies tend to underperform then.
Oil and the dollar impact each other in a number of ways.
One is what's called the invoice effect, which is the fact that oil is denominated in dollars. What that means then is that when the dollar weakens, oil prices tend to go up. And part of the reason for that is that oil-producing nations, like Saudi Arabia or Mexico, who receive dollar revenues, if the dollar is weakening, they would want to increase the price of oil to maintain their purchasing power of dollars.
Oil and the dollar also interact in what's called the petrodollar recycling effect.
If we use the example of oil-producing nations, when they receive dollars, when they sell oil, they then sell some of those dollars to buy European luxury goods, for example. And so by doing so, they're selling dollars and buying other currencies. So again, higher oil prices would lead to a weaker dollar.
Besides oil's impact on a country's economy, traders need to monitor how central banks respond to higher oil prices.
So if oil is going up, then the ECB would see that inflation is rising, which then would mean they would increase interest rates, which could then make the euro more attractive versus the dollar.
Thanks for watching Bloomberg, The Educated Investor. I'm Carol Biaggi.